Thanks for clicking! The mortgage stress test added to the financial resilience of Canadians as the central bank was raising rates. This according to new research coming from the Bank of Canada.
Yes, but at what cost?
And the research coming from the central bank comes at a particularly interesting time, as we just heard from Senior Deputy Governor Carolyn who publicly gave a scolding to the fiscal authorities over the extended amortizations. I had made the joke at the time that the Bank of Canada was claiming the housing market for itself, putting other would-be competitors on notice. But apparently, he still has more scolding to do.
There's more where that came from!
Which I thought was a joke, but the central bank appears to have taken it to heart, telling OSFI what a great job it's done at limiting delinquencies when the bank had to raise rates.
Don't f*** up in here.
And although the extent to which the Bank of Canada is getting vocal on its thoughts on other departments within the government is, as we'll see, entertaining, it also sheds some light on where the central bank thinks the real estate market, or more accurately, wants the real estate market to go. So what I'm going to do today is go over the report's findings, take a look at what it has to say about the housing market, and then discuss some implications. We will continue to track Canada's real estate market and any attempts from the Bank of Canada to alter its trajectory on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. On to the report. The report begins with the premise that since we saw Canada's banking regulator, OSFI, implement two stress tests not that long ago, 2016 and 2018, and then the central bank had to raise interest rates in 2022, this provides an interesting opportunity to evaluate the stress test's impact on the mortgage market as well as house prices.
Oh no, there's no need for that.
And the report does just that, comparing the implementation of the 2016 stress test, which implemented a stress test on all government-backed insured mortgages, so those mortgages with less than 20% down, with the 2018 stress test, which mandated that all low-ratio mortgages be stress tested at 2 points above the contract rate, or the minimum qualifying rate, or MQR, whichever was highest. So between 2016 and 2018, we had a stress test for insured mortgages, those mortgages that had less than 20% down, where you get the mortgage insurance from CMHC, etc. Then after 2018, those stress tests were applied to all mortgages, even those mortgages with 20% down. And as a brief side note, just to get this out of the way, following 2018, house prices did this, which probably should have alerted the experts that there is a direct connection between people's ability to buy a thing and the price of that thing, but obviously not.
Nothing like that will ever happen again.
No, but in fairness, a lot of those realtors in 2022, experts at their craft though they were, weren't realtors in 2018. Or in 2024 for that matter. And yeah, the study coming from the central bank did find much the same thing, that the 2016 stress test did constrain buyers' ability to borrow, though the balance of purchases just shifted to those with higher down payments, those with low ratio mortgages. So those with lower down payments and higher debt were effectively priced out of the market. They weren't able to qualify based off the new rules in 2016, and those with higher down payments picked up the slack, with the study finding that the new rules did not dampen mortgage or house price growth. With that said, the stress test did increase the overall quality of the borrower. In contrast, the stress test changes that came in 2018, which again strengthened the qualification standards for everyone, were quite different, with the study finding major slowdowns in credit and price growth all across the board. The study found that those areas which were most affected by the reforms, those areas which had the highest prices already, experienced a more pronounced decline in the number of mortgages originated, average mortgage size, and aggregate growth in local house prices than less exposed locations did. So, in general, the 2016 reforms pushed out those would-be buyers with lower credit scores and lower down payments, and then the 2018 reforms, which expanded the rules to everyone, dampened house price growth and credit booms.
You're dumb.
Yeah, as you can imagine, these reforms in 2018 were not well received by the real estate industry, mortgage brokers, and realtors alike, with brokers noting that these reforms were far too strict, far too stringent, with others in the industry noting that the rules would put a chill on a market that can ill afford it.
I'm kind of a big deal.
And the reason why all of this matters for the central bank's purposes, especially as we'll see later, is that these reforms helped to contain the delinquency rates when the bank started raising rates in 2022. The study found that the increase in delinquencies following the rate hikes were smaller in the areas most affected by the 2016 policy changes compared to those areas which were less affected. So, in those areas where the 2016 changes had the most effect after the Bank of Canada raised rates, they're not seeing as many delinquencies as is being seen where those 2016 changes did not have an impact. With that said, the study also found that those 2018 changes showed no significant impact on delinquency rates during the 22-23 monetary tightening. So, the 2016 reforms led to an increase in credit quality, the 2018 reforms limited house price growth and mortgage growth, but the 2016 reforms actually had a bigger impact on delinquency rates, which makes sense. Those with lower credit scores in general are going to have a higher debt load, and again, in general, are going to have lower down payments, making them more susceptible to delinquencies when the Bank of Canada raised the cost of borrowing. Now, granted, there are obviously some problems with this study in that the period that we really want to understand, the renewals come 25 and 26, is not studied for obvious reasons, but I think this is a good start in trying to understand the effects of the stress test, even though it was pretty obvious.
Could go either way.
But I think the real question is, why is the Bank of Canada conducting and releasing this study now? OSFI already noted a year ago that the stress test produced a more resilient residential mortgage financing system characterized by low default and delinquency rates. Is the central bank just double-checking the banking regulators' work?
I'm not trying to insult you. Just saying.
Be tough.
No, I don't think so. And it's a little strange coming so soon after the central bank publicly scolded the sitting government on extending amortizations, which was odd enough to hear at the time, and now we get this report praising OSFI for its regulations. And my guess is, and this is only speculation, I have no evidence to prove this, the central bank doesn't really grant me interviews.
No.
But my guess is this was a not so subtle message. Don't go repealing the stress test because you want the housing market to take back off during an election year.
How irresponsible do you all think I am?
Normally, I wouldn't think too much of the stress test, but again, it's just too odd that it came so soon after the warning coming from Senior Deputy Governor Carolyn Rogers. I think that the central bank is concerned that after seeing those 30-year amortizations, that the powers that be are going to continue to loosen the rules, pushing house prices back upward. When, in reality, I think the central bank would rather see them stagnate.
You're supposed to love me and all you do is hurt me!
With that said, this is obviously all speculation, though the timing of the release of that report, in conjunction with Deputy Governor Carolyn Rogers' messaging a few weeks ago, is definitely curious. We will obviously continue to track any messaging coming from the central bank on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.